Hey there, my name is Annie Trujillo. I'm with Southtown Realty and Keller Williams, and I'm here today with Drake Bloebaum. He is a loan originator with Neo Home Loans, and I've known Drake for years now. And the other day he put on a presentation. Neo Home Loans and Truly Title did a presentation, and Josh Metal did this incredible presentation. And I go to a lot of things. I do a lot of continuing education. I go to a lot of masterminds, trying to get all the information I can. And this presentation blew me away. I thought it was one of the most well put together presentations I've seen, really described in detail a lot of what's going on in our economy and what things have to do with the others and why economists think what they think. And so I asked Drake, being one of the smarter people that I know, to redo the presentation for us today so that we could pass it on to the consumer. It was originally put together for realtors, and I thought it'd be a lot of really great information for the consumer, whether you're buying a house or thinking about selling a house, to get the real nitty-gritty information and not just listening to whatever's on your news stream. So yeah, Drake, thank you so much for being here with me today.
Yeah, my pleasure. I think this is important information for our clients, our home buyers and sellers to know, because there's a lot of fear out there right now. And if we can help people come to a better understanding of what's going on in the market and the fundamentals, I think that's going to help them make better decisions and help them with their financial future. So I don't know if I'm going to be able to live up to Josh's presentation, but I will do my very best. He's got some pretty big shoes to fill. But our sort of thesis is that essentially the market's about to boom, right? We had a couple of boom years in 2020 and 2021, and most of 20, or at least the first quarter of 2022, and then everything's come to a screeching halt, and a lot of people are sort of paralyzed and scared. But our understanding of the economic data that's out there leads us to believe that we're about to see a market boom. And if people essentially are, in their personal economy, it's a good time to buy a house in the next year. They're better off doing that sooner than later, because what's going to happen over the next 6 months is will put them in a worse position if they wait. So let's just jump right into it. What we're going to try and answer today is, as a buyer, is this a good time for me to buy a first home? Or is this a good time for me to sell my home and move up? And is the housing market about to crash? And why shouldn't we just wait it out and see what happens after all these bank collapses? Okay, so we're going to try and give you some answers and some data to answer these questions. So here we go.
I just wanted to throw in there that this is the most important thing for consumers right now, is because the news is just screaming like high interest rates and things are crazy and don't buy. They constantly, I feel like, are telling people not to buy homes, but they don't actually have the data that we have. And so again, just kind of pushing this whole talk. I think it's so great.
Well, you've led me perfectly into my next slide, which is we are having a crisis of information right now. And this is based on what we call the negative news narrative, right? And so what this slide is quotes from the real estate correspondent from CNBC, Diana Olick, over the past 8 years. Right. And so what we've done is outline those dates on the left, given the headlines. And then on the right, we've shown how much appreciation and dollars you would have missed out on by listening to these negative news headlines and not buying homes. So assuming that you were looking at a $300,000 home in 2015, if you would have listened to her headline of Housing Today, a bubble larger than 2006, you would have not bought a home, and you would have missed out on 5% appreciation that year. In 2018, she said it's better to rent than to buy in today's market. That year, you would have missed out on $14,000 in appreciation, or 4.1%. And so over the last from 2015 to 2021, someone who listened to the negative news would have missed out on $200,000 of appreciation by waiting to buy.
Thanks a lot, lady.
Yeah. So yeah, I mean, we got to just remember that the goal of news organizations is not to their ultimate goal is their businesses, and they're trying to get you to click on their story and stay on their channel. And how do they do that? With sensational headlines, right? And so the problem is that it's easy to read those and let that seep into your consciousness and let that inform your decisions. So we've got to dig deeper and get better resources to our clients, friends, family, to give them better information. And so the problem is the news is successful, right? This is a NerdWallet survey that came out this year. It's a home buyer report, and they said 67% of potential home buyers expect an imminent housing crash. 61% told pollsters that mortgage rates are unprecedented right now. So in other words, they've never been higher than they are right now, which of course we know is not even close to true. We'll show you that in detail in a little bit. And 57% feel worse about their ability to buy a home in 23 because mortgage rates will be higher. They're already lower than they were in 2022, and we believe they're going to go even lower soon, and we'll talk about that more. But the bottom line is this is what mom and pop and average consumer believes about the housing market. Fannie Mae releases a home buyer survey monthly, and over the winter, it's been on the order of 16 to 20% of people believe that it's a good time to buy a home. So in other words, 80 to 85% of people think it's a bad time to buy a home. I get that. There's some things that are massively different than what happened in 2020 and 2021 and early 2022. But sometimes the opportunity is in the uncertainty, if that makes sense.
100%, because guess what? People were terrified to buy a home in 2020 also when interest rates were at 2.8%, because it was competitive and there were multiple offers and you had to give away a firstborn to buy a house. And so it's always going to be a scary thing. My broker has this little saying, to get the fruit, you have to go out on a limb, and anytime you buy a house, it's going to be a little bit scary. And today is no different in that way. So.
Yeah. So, I mean, think about, did you have clients during that time? I know I did in the 2020, 21 years where they said, look, this market is too intense for us. We're going to wait till things calm down.
Oh, yeah.
Right.
Yeah.
So, those people
and I always want to go, how's that working out for you?
Right. I mean, yeah. So those people missed out on a lot of appreciation in 21 and 22. And now, okay, the market's calmer, but now you get a 6% interest rate, right? So now the refrain that I'm sure that you're hearing as well as me, I'm sure, is now we're going to wait for rates to come down and home prices to crash, right? So let's talk about, we'll get into that in more detail. So this is what mom and pop think, right? This is what average Joe American thinks. Housing crash is coming, rates are higher than they've ever been, and it's going to be harder to get a home going forward. What are the wealthy of the wealthy doing? Well, they're seeing opportunity. So the opportunity is in the uncertainty. Wall Street is piling money into hedge funds to buy single family homes across the country. So this is an article that came out in October. They're projecting that Wall Street is going to own 40% of single family rental homes in the future, right? Moving forward. They've committed more than $60 billion to buying single family residences in neighborhoods across the country and turning those into rental homes. So the challenge is that now our clients, our regular people across America, are going to be competing with hedge funds to buy homes, right? You think that the 20 and 21 markets were challenging. We're going to get really challenging when you're dealing with hedge funds.
Don't these institutions also own the news sources that are telling us not to buy homes? Not to get too conspiratorial.
Yeah, I mean, I'm sure that there's some play into that as well. But the bottom line is Chase, Blackstone, there's multiple hedge funds that are stockpiling money because they sense that there's an opportunity in real estate. In fact, one of the larger hedge fund managers was quoted as saying the opportunity right now is greater in real estate than it was in 2008.
Wow.
So think about that. At the bottom of the crash, they're saying now is a better time than 2008.
Wow.
So we'll talk about why we think that is and why Wall Street thinks that single family homes and residential real estate is worth putting $60 billion into. So why is that? So what does Wall Street know that mom and pop Main Street do not know? Well, Wall Street has a lot of data all the way back into the 40s. And you can find this as well, but this is not something that you're going to see on the CNN nightly news. Right. So let's just go and look decade by decade what housing has done. So now these are appreciation rates broken down by year as far back as we have data for. So back in 1940, 41, there wasn't any data, but starting in 1942, housing appreciated 3%. And you can see it appreciated quite a bit during the 40s, total of 129%. Okay. So now we roll to the 50s, 36%, not as good as the 40s, but still not bad. 23% in the 60s, 130% in the 70s. What was going on in the 70s? Inflation, right? What's that?
I said, you tell me.
Yeah, inflation, right? And we'll talk about inflation as actually, housing is one of the best hedges against inflation. And we can talk about that more as we go. But the 80s, still 77% appreciation. Well, 90s, we had some negative years. So we had a negative 1%. So depreciation, how homes were worth less in 1990 by 1%. 1991, they stayed flat. And then we started accelerating again for a total of 30% in that decade. 2000s, right? The Great Recession decade, still up quite a bit. Started to get really hot in 2001 through 2002 through 2005. And then we had our crash. But we were still up 66% over the decade. 2010s, recovering the first couple of years from the Great Recession. And then we continue to go up for a total of 45%. In the 2020s, we're 3 years in and we have 39% appreciation. And I think we have the total. We don't have the total here, but so basically the record, the win-loss record for housing since 1942 is 73, 7, and 1. Pretty amazing, right? There's not that many investments that only have 7 down years in 90 or 80.
Yeah.
Right? It's a 90% win record. For example, stocks, there's a bear market in stocks every 10 years, right? That means a 20% reduction in the value of stocks every 10 years. So this is part of what Wall Street is looking at. Okay. Another cool thing about real estate is that you get to use leverage. So this is the average appreciation since 1991. So across the country, it's 300% appreciation. So your $100,000 house in 1991 is $300,000 at the end of today, right? Different states, of course, we're in Utah. And interestingly enough, Utah led the entire country since 1991 with 587% appreciation. Craziness.
Yeah.
So in 1991, the average home value was $200,000. In 2023, that home is $1.17 million. Okay. That's how much that appreciation is. This is in Utah, right? And if you would have put 10% down, the cool thing about housing is that you get appreciation on the entire home price, but you only had to put down as little as 5%. We've shown 10% here, but if the $200,000 house becomes a $400,000 house, you just turned $20,000 into what? $180,000, right? So in this case, the return on investment was 5,878%. So leverage is a really powerful thing in real estate.
Yeah, this was one of my favorite parts, just from a consumer perspective. Like, obviously, this was put together for a room full of realtors, but that's why I told Drake, I was like, we need to make this available for the public to see so that people can really wrap their heads around, like, real estate's a great investment. It doesn't even matter when you buy it. Yeah, it's great.
Yeah, I mean, what we say frequently is don't wait to buy and wait, because time is your friend in real estate, right? So we'll get into that more as we go as well. Okay, so this is kind of what Wall Street knows that Main Street is not thinking about. It's really hard to project this sort of thing into the future, right? Like if I tell you historically, real estate has doubled every 20 years. Think about that. So your $1 million house today is going to be worth $2 million in 20 years. If you go back and look at the data, it's pretty much spot on.
And it's so hard to conceptualize, even from people in the industry. You know, you look at a house that's $500,000 today and you're like, really? Someday that's going to be $1 million? And the answer is just yes. Like, the data's there. You got to, like, your imagination isn't even needed. It's like the data is just there. And it's happened already in my lifetime, from the very first house I bought that I never thought would be worth. I thought I was buying, like, I thought I was being so stupid, and it's worth like triple what it was when I bought it 7 years ago, 8 years ago. It's crazy.
Every investment property I've ever bought, I've thought, gosh, I might be overpaying for this. And now if I could go back and buy it for what I bought it for, then I would do that very, very happily in every single situation.
And now you wish you had bought 3 of them.
Oh, 100%. I wish I could go all in 2012.
Yes.
I wish I could go back to that time. But again, you and I have talked about this before, right? The best time to plant a tree was 20 years ago. The next best time is now.
Yeah.
So
anybody who's heard me say that 100 times, I got it from Drake.
Okay, so our buyers are afraid, right? I hear that every day when I'm talking to clients. Like, is it a bad time? Isn't the housing market about to crash? The Fed keeps raising interest rates. They're going to keep raising. I had one client tell me she thought that the Fed was going to raise to 19%. I was like, I'm not sure where he got that, but okay. So the thing to understand, and we're going to harsh on this through the whole presentation, is that the Fed tightening interest rates is not the Fed raising mortgage rates. They're two separate things. The Fed raises the federal funds rate, which impacts short-term lending like credit cards, car loans, home equity lines of credit, those sorts of things that are variable and short-term. Okay, mortgage rates respond to inflation. But why is the Fed doing this, right? Why is the Fed tightening rates so much and jacking them up? Well, they've been doing it, first of all, at the fastest pace in history, right? This chart shows the path of the federal funds rate over the last, 1, 2, 3, 4, 5, 6 cycles of them raising, right? And so this cycle, the dark blue, is the fastest they've ever raised rates in the history of the Fed. Why? Because inflation was getting out of control. They waited too long to get started. And so they had to be incredibly aggressive raising that rate to slow down the economy. So why are they doing it? They're doing it to destroy demand. So what does that mean? In 2020 and 2021, we had, of course, this crazy real estate market and crazy everything market, right? Where there was all this super cheap money, which the Fed had to lower interest rates during the beginning of COVID because they were concerned about deflation, right? So they lowered interest rates to spark the economy, drive the economy. People were out of work because of COVID, right? They weren't spending as much money, so they had to lower interest rates. Well, that went too far. So now they have to increase rates to destroy demand and slow down the economy. Their goal is to stabilize asset prices like homes, stocks, everything, Bitcoin, right? The Fed wants assets to go up in price, but slowly. You got to remember that the Fed's mandate is 2 things. It's a dual mandate. The first thing is to maintain price stability. What does that mean? They want prices to go up slowly and smoothly. Their goal is 2% per year, right? Their inflation goals, they want inflation to be at 2% per year. We were at up into the 7s in the fall of last year. And then to to keep full employment. So they're always trying to balance this teeter-totter of stable asset prices and full employment, right? So what they were scared of in COVID was unemployment shot through the roof in March of 2020, right? Everybody had to stay home. Nobody could go anywhere. And so unemployment went through the roof like we've never seen. So they had to do some never seen before interventions. And now they're unwinding those as quickly as they can. Did I explain that clearly enough?
Yeah, and I think we all felt it. Like on some level, when I watched this presentation, we felt that inflation in a way that like I personally in my lifetime hadn't felt it before. And maybe it was because I was too young or I didn't have any money or it didn't really matter. But it seemed like all of a sudden everything was so expensive. And so in a way, like learning that they're trying to mitigate that with the interest rates, because as a realtor and I'm sure a loan officer, you can be like, oh, these interest rates are terrible. Nobody's buying, I'm not working, or whatever it is. But it's like when you realize that they're just trying to kind of help out the economy right now so it doesn't sting quite so bad, then you can forgive them a little bit for it. That's how
Yeah,
I feel.
totally agree. I mean, the Fed is doing the right thing, right? They're raising interest rates because inflation hurts everybody. They call it the invisible tax, right? And it hurts the lower end of the socioeconomic scale the most, right? Because folks that are wealthy have more assets and more wiggle room to deal with these sorts of things, like whatever, toilet paper going up from $5 to $10. But the folks at the lower end of the socioeconomic scale are hurt the most with inflation. So it's great. Inflation is a negative thing. Generally, you want it to be slow, steady, and smooth at around 2%. That's the goal. And they're doing the right thing to do it. They were just too slow in doing it. And so now they're playing catch up. So let's talk about what inflation is, because I think a lot of people don't have a crystal clear understanding of that. And we'll see how it affects everything. So just put really simply, inflation is too many dollars chasing too few goods. Simplest thing. You've always heard supply and demand, right? So what happened during COVID? We had all these container ships off the coast of LA, right? Full of all of our stuff. There was no stuff to get. And at the same time, you had the Fed lowering interest rates so everybody could borrow on their home equity lines really cheaply. Their credit cards got cheaper. Their car loans got cheaper. So they said, sweet, there's all this money out there in the economy. I'm going to borrow some of it and buy stuff, right? But there wasn't enough stuff. So there was too many dollars chasing these goods that drove the price up. Okay, so there was no supply. There's tons of demand. Prices went up. Same thing with houses, right? So the Fed starts to hike interest rates, right? So the Fed raises interest rates. And so now that new car that you bought last year with a 3% interest rate had a $500 payment. But this year you look to buy a new car and that same car has a 6% interest rate. And so now your payment is $750. So you say, maybe I'm going to pause on buying that car this year, right? And the same thing with your credit card. Your credit card payment went from $150 to $300. Well, now you can't go out to dinner, right? Because you got to save that. So by the Fed raising those rates, they're pulling demand out of the market. I think of it like a vacuum, right? They were in COVID, they were dropping money out of a helicopter to give it to everyone as much as possible. Please spend this money, keep the economy going, don't let it crash. Now they've got a massive vacuum and they're sucking all that money out of the economy. Actually, there's an interesting chart that's not in this presentation, but the money supply is tightening for the first time in generations because of what the Fed's doing, which is good, right? That makes our money more valuable and there's less of it. So again, the other thing that the Fed raising rates does is it means that banks can raise their rates on their checking and savings deposits, right? Because they're getting a higher rate of return from the Fed. So now if you take a look, there's checking accounts, there's money market accounts that are paying 4% right now. So you can have a no risk place to put your money for 4%. That's not too bad, right? So do I want to spend that money or do I want to leave it in the bank and let it make money for me?
Oh, that's super interesting. I missed that point on the first presentation. I was hoping I would get more out of it this time.
Yeah, Yeah, so that's a message to people too. If you're sitting in a bank, not every bank is this way, but if you're sitting in a bank that's got like 0.25% on your checking account, you got to move. You can do a lot better right now. 2% on a checking and savings account, and there's multiple money market accounts out there that are 4%. So, so consider shopping around a little bit. Okay, so that takes more money out of the economy. Then supply chain begins to improve, right? All those container ships were able to get in. Now there's more stuff in the economy. Retailers have built back up their supplies. And so now instead of 4 bags of money chasing one cart, we have 1 for 1, right? So supply and demand even out, and that maintains price stability.
My brain just goes to mountain bikes, because during the pandemic, you could not buy a mountain bike to save your life. And now they're on sale because they have too many of them. And so it's like that's the housing market.
That's a perfect example. That's a perfect example. I've been shopping for mountain bikes recently, but maybe it's time.
You can find sales now on them here.
Good to know. Cool. So let's just take a look at how this went down in the economy. Okay. This is sort of the most important chart, I think, of the whole thing. And what it shows really is that inflation drives mortgage rates, not the Fed, not the federal funds rate. Inflation drives mortgage rates, and mortgage rates are driven by what are called mortgage-backed securities. They're bonds that are traded in the open market. Think of them as sort of the opposite of stocks, right? A bond is an instrument where I give you a set amount of money and you pay me a set rate of return on that money. And the reason that inflation is bad for bonds is that when you're paying me a fixed rate of return, so let's say I give you $100,000 and you say I'm going to pay you 5% interest on that. So that's $5,000 a year, right? So I'm getting $5,000 a year from you, and you're getting to use my $100,000. So if inflation doubles, now I can only buy half the amount of stuff that I used to with that $5,000. So fixed rate of return instruments like bonds, inflation is the arch enemy of those things, right? So what that means is next time I come to you and say, hey, I want to lend you money, you can't charge me a 5% rate of return. I need 10% now because inflation doubled, right? And so that's how inflation works with bonds, which mortgages are bonds. Okay, that makes sense?
Yeah, it does.
Okay, so let's just follow these two trends, right? So the sort of pink line is core CPI, which is the consumer price index, which is how inflation is measured. Okay, that's how the Fed watches. It's basically, that's what inflation is the core CPI. Okay, and the blue line is the 30-year fixed rate mortgage, so mortgage-backed securities. So as you can see, back in January 2018, rates we just started at that time, but the core inflation started to go up and rates followed, right? Whoops, I switched slides accidentally. Core inflation went up and mortgage rates went up. So then early part of late mid 2018, inflation cooled off a little bit and mortgage rates cooled off a little bit. Again in 2019, July of 2019. Sorry, I keep switching slides, trying to just click on things to point at them. So July 2019, inflation starts to heat up again, rates bump up a little bit. Okay, and then so what happens in March of 2020, that gray bar represents a recession, right? And a recession is a receding of the economy. In other words, the economy is, think of it like the tide. The tide recedes, it goes out, it gets smaller, right? That's what's happening in a recession. The economy gets smaller. And so we had a massive drop in inflation right there in March, right? And what that white bracket, the QE period, means is that's the Fed lowering rates. And so what that QE means is quantitative easing. And what they did during that time, just like I said, is they were dumping money out of helicopters, right? They lowered interest rates as low as they could. They were buying these bonds, mortgage-backed securities, and U.S. Treasuries to the tune of $9 trillion. They were buying $4 billion a day in mortgage bonds to keep mortgage rates, to peg them in the low 3s, high 2s, right? So I think of it as the equivalent of them saying, we believe that Apple stock is so integral to the economy that we're going to buy $4 billion a day of Apple stock to keep the price at $1,000 a share, right? It's the same thing, but the inverse of that, if that makes sense. So this QE period, they are buying these bonds and pegging these interest rates at zero because, as we mentioned, their dual mandate, the first part is maintain full employment, right? And as of March 2020, a lot of people didn't have jobs. So to keep the economy from crashing, they were quantitatively easing, so making quantitative money easier to get. They pegged the interest rates during that time. But as you can see in, what was that, about March of 2021, inflation started to ramp up very quickly, right? That's the red line. However, the Fed kept going with their monetary policy of keeping rates low. And they kept on until January of 2022. And look where inflation was at that point, right? So think of the blue line as just being artificially held down by the Fed as that inflation rises because they were worried about their first mandate, which is in full employment. So when they finally said, okay, gosh, inflation might be getting out of control. If you're watching in the news during that time, they kept using the term transitory, right? We think this inflation is going to be transitory. So in other words, it's just because supply chains are tight. As soon as COVID's over, supply chains will open, inflation will pass, and we'll all be good. Well, they waited too long. No. So when they finally let the QE up, they stopped buying bonds. They started raising their rates. As you can see, mortgage rates rocketed up closer to 7%, up slightly above the inflation numbers. And as inflation peaked and came down, you're already seeing mortgage rates peak and come down. Questions?
I would love to see this on a timeline from 1940s too, because my guess is that it all looks like the left side of that graph, like forever and ever until this one crazy thing happened in our economy. I don't know if there's been other QE periods in.
The only one was back in 2008.
Okay.
That's the only other time they've done that. So that was the first time that they bought mortgage-backed securities. And I remember, because that's right when I first got into the mortgage business, they announced that, the world was imploding, rates were going up because everyone was scared to lend anyone money at that time. And I started reading all these books and all that. And I was like, why don't they just buy mortgage-backed securities so that they can lower, keep the price stable and lower the rates? Sure enough, a month later, they announced that they're going to buy mortgage-backed securities. I felt really smart at that moment.
I bet, yeah.
So cool. All right. So now let's see. So now that we know that inflation drives mortgage rates, let's see what's going on with inflation. Okay. So this is a close up look at what goes into the consumer price index or inflation, right? It's currently at 5.6% year over year. So what these are called inflation prints. So every month, the Bureau of Labor Statistics comes out and gives a print on what the consumer price index was for that month. They take the 12 months, add them up, and that's your inflation number for the year. So each new month, the last month from 12 months ago falls off, and we have a new number, and that makes up the new 12 numbers that make up the average. So let's take a look at where we're headed and what we're going. So the prints that we've just most recently replaced are December, January, February, and March, the pink ones, right? And those four add up to 2%. Okay. The ones that we're about to replace are the green ones, the 0.6, 0.6, 0.7. So you can see that's the highest part of the inflation curve in the last year, right? And so as we get these lower numbers, the higher numbers are going to fall off and the average is going to come down. And so we're going to see in the next few months these lower consumer price index numbers because the Fed's strategy is working, right? They've raised rates, that's destroying demand. People are buying less stuff. And that means, and there's more stuff to buy. And so that means prices are starting to come back to earth, like you said, with mountain bikes. That was a perfect example. And that's how we see and know that inflation is cooling.
Well, and this whole thing is just so trippy to me because I'm sure that other people who will be watching this are like, I can see this in my own life, as like inflation was going up, I was feeling that, right now I'm spending way less. I used to just go on in 2021, just go on Amazon and buy whatever and was feeling all loose and relaxed about it. And now I'm like, you know what, I'm just gonna reel it in a little bit here and there, even though the bikes are on sale, like my old bike's pretty good, I'm gonna stick with that. It's like just looking at all the data, you're like, oh yeah, I'm just like another consumer on this big old wave riding.
I mean, people give the Fed a hard time, but they do have a lot of smart people working there, put it that way.
Yeah.
So let's just see, right? Is it working, right? What's going on with the consumer? So here is in billions of dollars, the total of credit card and other revolving debt that Americans are using. Okay, so we're looking back from January of 18 to July of 22, essentially a little past there. It's really the current day. So we're cruising along. People are just slowly using more and more credit card and revolving debt, right? That's sort of a natural phenomenon. The economy is growing. There's more people. Those numbers are going to go up. So what happened in January 2020? Again, helicopter money, right? Stimulus payments, PPP loans, right? Those were big. And then beyond that, people were just stuck at home, right? They couldn't travel. They couldn't go out to dinner, right? So they couldn't spend as much money. And so what did they do with the money that they got and the money that they weren't spending? They paid off their credit cards and they ramped up their savings, right? And now we're starting to see, okay, back to the game. People are out and about. Credit cards are going back up, right? I mean, if you draw a line from the peak of the gray bar, which is a recession, to the peak on the far right, if you take out the dip, it's like a perfect line, right? It just would have kept going. So we're back to where we would have been had the recession not happened, essentially. But you can see there's a little dip on the top right. They're starting to maybe slow down, but those are happen throughout the chart. So okay, they're living off credit cards, right, and depleting savings. Here's the personal savings rate from January or late 2019 through now, right? Savings went up in COVID. Now people are losing, spending their savings. They're not saving as much. The personal savings rate is, what is that, 3.5%, right? When it was up to 35% at one point. Gosh, that's a lot.
Yeah.
So at your house, what happens if your savings are depleted and your credit cards were maxed out?
Just be crying.
that and you're not buying a new mountain bike,
Correct, yeah.
right? So that's what's happening, right? The Fed has ramped up their federal funds rate. People have limited out their credit cards and spent their savings, and so we're seeing demand destroyed. When demand is destroyed, that leads to lower prices, right? Okay. And when millions of households across the country are spending less, we see deflation, not inflation. Okay. So this is a pretty in-depth chart, but it's pretty powerful. This is it's called the LEI, Leading Economic Indicator Index. So this is a chart that breaks down GDP, employment figures, industrial production, consumer spending, inflation, home sales, home building, construction spending, manufacturing demand, retail sales, all of these leading economic indicators, and puts them into one number. And it charts this. Is it going up or down, right? So if leading economic indicators are going up, the economy is expanding and growing. If it's going down, the economy is shrinking. So as you can see in this chart, every single time, it's a perfect predictor of a recession. Every time it goes down, we get one of these gray bars, right? Every time it turns and goes down, there's then a gray bar, which is a recession, right? And here we are on the top right. It's turned over. It's been going down for 11 straight months. And we actually just today had another print. It was below, like way below expectations of what So every time one of these numbers comes out, economists have a guess at what it's going to be, and then it comes out, right? And it came out way below where economists thought it was going to be, indicating that there's even more negative leading economic indicators. Okay, so perfect predictor of a recession here. Why does that matter? Why does that matter for somebody that's considering buying a home? Well, mortgage rates tend to go down in recessions, right? Because there's less economic demand, there's less inflation. So that's good for bonds, which is what mortgage rates are. When there's less inflation, that means in our example, my $5,000 a month that you're paying me on my bond that I bought from you, I can buy more stuff, right? So it's a better instrument when in periods of recession and deflation. Okay, so this is a chart of mortgage rates since 1972, and it shows you in the gray bars the recessions. So every single time there's a recession, mortgage rates go down. Okay, because by definition, they're deflationary.
Well, and for every person who calls our rates today high,
yes,
like, please just look at this chart, you know.
And we're going to add more detail to this, so you'll see that mortgage rates are not historically high right now. They're higher than they've been in the last few years, but they're not historically high.
But also the last few years have been historically low.
Incredibly low.
They're not the median here. Like the last few years, it's like for every smart guy out there trying to time the market, that was the time. If low interest rates was your priority, that was the time. If you missed it, you missed it. That's it. Like, I personally don't think they're ever going to be that low again, because that was like during a worldwide pandemic. We had all kinds of crazy stuff going on, like. So anyway,
100%. If there are people out there that are waiting for rates to get back into the 2s and 3s, that is a terrible strategy. It's not happening, because the only reason it did happen is because the Fed was buying $4 billion a day of mortgage-backed securities. So shy of another. What's that?
I think we need to make t-shirts that say that. The only reason rates for that was $4 billion a day.
Like a tattoo of it.
Yeah, for it.
Okay, so Black Knight did a study that showed 5 million more renters and homeowners can qualify to buy a new home for every 1% reduction in interest rate. Okay, so every time interest rates go down 1%, 5 million more people can afford to buy. Okay, so here's what happened all the way back into the 80s when rates went down, right? So we had rates. Ask your parents what their first rate on their house was. For mine, it was in the high teens.
Yep.
Right. So we've seen rates in the 16, 11, 16, 18, 13. But let's see how many more people qualified to buy. Back in the 80s, 20 million more people when it dropped 5% or 4%. 20 million people again in early 80 or 82. 11 million in 1990s, 3 million in 2000, 5.6 in 2008 when they dropped, and another 5 million were qualified in early 2020. Okay, so that's what happens when rates go down, and that's what we're projecting. Okay, what about home prices, right? I've always heard that recession equals housing bubble, housing crisis. Well, I haven't heard that. That's what the news has always told me. Right? And that's what my parents who went through the Great Recession said, my uncle, right? But that's not really what happens in recessions. Let's talk about why. So remember that mortgage rates go down in recessions because inflation goes down, right? So what happens to housing when mortgage rates go down? I'm sure you know the answer to this. Yes, they go up. Why? Because housing is now more affordable, right? I couldn't buy that $500,000 house when rates were at 7%. But now that they're at 6, I can buy a 550 house, right? So more people, it allows more people to buy, demand goes up, and so therefore prices go up. So this is the housing price index back from the 60s. So you can see every time the gray bars again are recessions, every time there's a recession, housing prices go up. There's one outlier, of course, and that is the Great Recession right there in 2008. And so why is that different than now, right? The reason is, I think we'll have a slide on this in a minute, but the reason is that the cause of the recession
Different kind of
was
recession.
bad mortgages and overbuying of homes, right? That is not even close to the case right now, and we'll talk about that in just a minute. But that is the one outlier where, you know, the recession didn't equal houses going higher.
I think you said overbuying, but did you mean overbuilding of homes? Or maybe it's both.
Overbuying and building back
Okay.
then, right?
Okay.
I mean,
Yeah.
that was the period where, you know, if you could fog a mirror or spell your name, you could get a mortgage, right?
Yeah.
But like I was lent, my very first property was a fourplex. They lent me 100% of that fourplex without verifying my income, right? I was 27 years old buying a $500,000 fourplex without verifying my income.
Wow.
Luckily it worked out, but it didn't for a lot of people.
Yeah.
So yeah, bad mortgages and overbuilding, oversupply of homes, which we'll get into a little bit in just a minute. Okay, so this is what happens. So rates down because inflation is down. Recession equals rates down. Recession equals home prices go up because rates are down and housing is now more affordable and more people can buy it. Okay.
So for any of my clients, and I've had several that have said, you know, we've just decided to wait until interest rates and prices go down, what would we say to them?
You would say you're probably not going to get one without getting the other.
Yeah.
Right.
You got to pick your poison on that one. They don't happen at the same time. At least,
Yeah.
Certainly not in Utah. I will tell you that much.
Yeah, just not historically, right? Yeah, they're just opposite things.
Yeah.
So, okay. So the other challenge though is that we talked about a little bit about supply, right? And we're going to get more into that in just a few minutes, but supply was one of the big problems in the recession. There were way too many houses and not enough people to buy them, right? So that prices had to come down during that time. And there was in the Great Recession back in 2008, right? We were overbuilt on houses and ran out of people to buy them. Prices crashed. So what's going on right now is that over the last couple of years, 80% of borrowers have secured a mortgage rate below 4%, right? So it's very affordable for those people that got in. And we've had some of the strictest underwriting guidelines in the past since 2008, 2011 or 12 that we've ever had in the history of mortgage. And so the loans are underwritten really well, and the people that are in homes can afford them and they're comfortable because their rates are low, right? This is going to be a bit of a challenge in terms of getting people to move, right? I mean, there's a lot of people now that are like, gosh, I'd sure love to move, but I just can't sacrifice my 2.75 interest rate, right? Yeah. Even though my 3 kids are sharing one bedroom. So that's a part of it. The other part is that back in the 2008s, the average equity in homes was much lower. Okay, so this is the average equity in all homes across the country, keeping in mind that some people own their homes free and clear, and some people put 3% down last year. Back in 2008, it was 19%. But there were so many people that, like myself, I got 100% financing on a fourplex, right? That doesn't exist now. And so the problem is when there was a slight downturn back then, nobody had equity to deal with it, right? And so now people have 58% equity in their homes. And so even if prices come down a little bit, you're not going to see foreclosures because they can still sell their house at a massive profit.
This is such a good point, because again, clients all the time say, we want to look into getting a foreclosed house or something like that. We want to get the great deal on the house. And I go, where are they? They don't exist. They're just not around. There's a couple here and there, one-offs. And it's because people have too much equity in their house. They can't lose on it.
That's true. They have no reason to let it foreclose or short sale or any of that because they don't have any. They have so much equity. Even if they had to sell it at 10% lower than market quickly, yeah, they could, because they have so much equity and they wouldn't be upside down. That was a problem back in 2008. Everybody was upside down, and so there were shorts. Every street had 5 short sales on it.
And that goes back to our discussion yesterday. Is, I think people have this vernacular in their head from 2008. It's like this trauma-induced vocabulary that they learned that's like short sale, crash, bubble, all these things. And I love this presentation because it's like, those things aren't a thing anymore. They're not words that we use anymore in this industry.
Yeah. Thankfully, that was not that fun of a time where we had to deal with a selling bank of a short sale, man. Those are not that fun to deal with. We have our new challenges, but at least that's not one of them.
Yeah, fair.
So let's see what was going on in terms of supply, right? This is why. So what happened in 2008 that is not happening now? This is one of the biggest points is, right, we are short the number of houses. This is why Wall Street wants to buy houses, because they know there's a massive undersupply of homes. And when there's an undersupply of anything, prices go up. When there's an undersupply of toilet paper during COVID, right, prices go up. Demand is high, supply is low, prices go up. So the gold bars on this chart are housing completion. So in other words, builders completed a house and put it on the market, right? The blue bars are formations. So that is, I have 3 kids. My wife and I have 3 kids. We're one household right now, but if my 3 kids turn 18 and move out, now we turn one household into 4 households, right? So household formation, so that's how many families, and families need to buy houses, right? So what was happening in 04, 05, 06 was builders were just high on easy money from easy mortgages, right? And they were building. They thought the party was never going to end, and they weren't paying attention to household formations. And you can see back in 04, 05, we're kind of cruising along at that 1.6, 1.7 million household formations. And then all of a sudden in 2006, boom, household formations fell off a cliff, right? Josh talked about this in his presentation, but 30 years prior to this, 33 years to be exact, which is actually the prime age for people to buy a home. It's like the #1 age for people to buy a home is 33 years old. 33 years prior to this was the advent of Roe versus Wade, right? So you have more people able to take their reproductive health into their own hands at that time. And therefore you see a smaller number of household formations, less kids 33 years later.
That was so interesting to me. Like, so many things go into all of the economics of this, and that one just blew my mind.
It's crazy, right? And demographics. And when you take a look at our state, Utah, the demographics, they're powerful in terms of showing what's going to happen in the next, call it 30 years.
Yeah, I mean, our formation chart is going to be wildly different than a lot of places, that's for sure.
Yeah, that's probably another webinar, but so as we can see, they got it together, right? So back so in other words, the gold was exceeding the blue. We had more homes being built. Builders didn't figure out stop building homes for enough people until 2010, 2011, 2012, right? See, we got back in balance where they were building enough homes for the household formations that we're having, but we still had this oversupply of homes during that time, right? But that got cleaned up all through the 20 teens, right? So you can see that household formations have been growing and they've been exceeding. Builders have not caught up. Builders are still not keeping up. They learned from the last crash, right? That they didn't want to overbuild and go out of business. So many builders went out of business that time. So look at 2023, right? We've got all these household formations and there's so much less than the housing completions. So again, home supply is low, demand is high. That equals higher prices. And it also means that we're not in a situation like we were in 2007-8, because there's more families and less houses available. So let's break it all down, right? So here is the comparison to the last Great Recession housing cycle to currently, right? So what did we have? Job cuts back then. The unemployment rate was upwards of 10% during the Great Recession. Right now, it's 3.6%. The Fed is trying to cause some unemployment so that they can, again, destroy demand and slow down the raise of asset prices. But they're having a really hard time doing it. We still have some of the lowest unemployment we ever had. Total jobs, 138 million back then. We have 158 million now. So we've got 158 million jobs chasing fewer homes. Subprime loans, like we've talked about, were prevalent. They were everywhere. Now, you can't get a subprime loan. They don't even exist. The 5-year cumulative new home construction. So in other words, the leading 5 years leading up to the crash, they had built 7.65 million homes. Now they've built 4.6 million homes leading up to in the last 5 years, right? So 40% less homes for teens and teens of millions more of more families. Okay. The inventory that was on the market at that time, there were 4 million homes for sale. Right now, there's less than 1 million homes for sale nationally.
That
Right.
number's so wild. Yeah.
There's 1 million homes for sale. There's 330 million people in the United States, right? And that inventory on market doesn't account for under contracts.
Yeah.
Right? So it's really like 600 homes on the market, 600,000 homes on the market.
It feels like that.
Yeah, it does feel like that for sure. Back then, mortgage delinquency was at 10%. So in other words, 10% of people were late on their mortgages, which doesn't seem like a lot, but that's an insane number, right? 10% of people were late on their mortgages. Now it's 2.8. That's way more historical. Homes in foreclosure, 4.6. That also doesn't seem like a lot, but when you consider that it's almost 10 times what it is right now, it was insane. Like we said, short sales everywhere. I mean, you could go down to the courthouse steps and there were just pages and pages of foreclosures that you could buy during that time. Again, I wish I could go back to that time.
The coulda, shoulda, wouldas in real estate are brutal.
Coulda, shoulda, wouldas, absolutely. All right, so this all leads to our prediction for 2023. Here's what's going to happen, and we think why you should feel safe investing in buying a home. Take advantage of the low demand right now, lower demand, and get into a home before rates come down, which is going to drive prices up even further. And you're going to have those woulda, coulda, shouldas all over again. Okay. So home affordability is going to continue to improve for 3 reasons. Inflation is trending downward, and that's going to continue, right? Mortgage rates are decreasing, and that's going to continue because inflation is decreasing. Incomes are increasing, right? Incomes are up 8% year over year. So that means I have more money to buy stuff with. Housing supply is going to remain very low because builders are still not building for the amount of families that need homes. And we've still got households growing and creating new homes, right? So lower rates, tight supply means we're going to have prices on homes going up. That means low single digit appreciation for most of the US with a pickup in activity as mortgage rates come down. We think they're going to be in the low 5s by the end of the summer.
Yeah.
So my advice to you, potential home buyer, like I said at the beginning, if it is in your personal economy, in your family, a time that you're considering buying, like say in the next year, be brave and push yourself to get it done sooner than later, because when rates drop, demand is going to go through the roof, and you're going to be back to dealing with multiple offers, offers over asking price, appraisal gaps, all of these things that we were dealing with in 2021 and 22 that were challenging, but you're going to be dealing with them with 5% rates instead of 3% rates.
And you can always refinance. You know, if you buy now, even if interest rates were at 8% today and you bought now, we can still get you closing costs and rate buy downs and all this stuff. And guess what? If they go down to 4% magically again, you can refinance then. So,
That's right.
But you can't go back and get today's prices in 6 months from now.
That's right. Cool. Well, I think we got it.
Got it. Awesome. Thank you so much, Drake. I love this presentation. I want it to be shared all over the whole internet to just offset all of the misinformation that's out there. And yeah, you knocked it out of the park. Thank you. Did great.
Thanks so much. All right. We'll talk to you soon.